Next, we have portfolio lenders. Portfolio lenders are really cool because when I was first getting started, I struggled with this because I would always hear, "Oh, Brian, you could do, 3 or 4 deals, but then your debt to income ratio is going to get bad and they're going to cut you off. The bank's going to cut you off and then you just can't do any more loans." And I'm like, well, how did people get 10, 15 deals? Oh, I don't know how they do that. The bank must be making an exception. Nobody knew, right? Because nobody that I knew has scaled. As I scaled, I started to learn that, oh, there are portfolio lenders out here. They're doing DSCR loans. So they're just looking at the cash flow of the property and they'll do 100 deals in a year. They'll do 200 deals in a year because they're portfolio lenders. What a portfolio lender does is they build portfolios of loans from all across the country. So they'll underwrite every 6 to 8 months $600 million of mortgages. And then they package them and sell them to big land trusts, national land trusts. So they sell them to trusts that buy debt. These guys just come in, they're billion-dollar REITs essentially, and they just buy debt. They buy paper. So they use these types of portfolio lenders to underwrite nationally, and then they buy the debt as long as it checks and balances all the different cross checks. You'd never know this until you start to scale and get to the next level and really pick the brain of these lenders. But this is what they're doing. And they get paid a fee to underwrite and sell that debt. So when they sell all that debt, they keep a piece of it, which is a servicing piece. So they get some type of residual income and they get an upfront fee. They might get 1%, a point on 600 million. Like they're getting it in. Here's what a portfolio lender does. They don't care about your debt to income ratio. They usually charge 1 to 2 points. So 1 to 2% of an origination fee. And then they'll charge like a market rate interest rate. And this is fully amortizing. So before, the hard money is interest only, meaning if you take a loan for 100K and pay 12% on that for a year, you pay $1,000 a month for 12 months. That's $12,000. At the end of that period, you still owe them 100K because it was an interest only loan. You were only paying the interest. With a portfolio loan or a 30-year fixed mortgage or a 15-year mortgage or a 10-year mortgage or 20-year mortgage, those are amortizing. So you're paying a combination of principal and interest. So if you paid for a year on a $100,000 loan with a portfolio loan, which is fully amortizing, when you came back at the end of that year, you wouldn't owe 100K. You might owe 96 because most of the upfront payments on these amortized mortgages are interest, but there's going to be some principal pay down. So that's important. You could set this up on a 30-year term, put a tenant in, it cash flows, the tenant pays off all the debt. You can have those types of situations. They will run in 5, 10, 15, 20, 30-year terms, and you can do fixed rate or you can do annual renewable mortgages. You guys should know, if you've been following me, that I don't mind annual renewable mortgages right now, especially if you're planning on refinancing into lower interest rates as rates fall into 2025, 2026, right? And they're probably going to. Most people are going to time the market, get an annual renewable mortgage as it goes down, refinance, boom, lock that thing in 2025, 2026 at 5%, 4%, wherever it gets down to. So definitely play the long game here. What you don't want to do is get a 30-year and then it has a 5-year prepayment penalty of 5, 4, 3, 2, 1 points. Meaning if you try to refinance it in year 1, you'd pay 5% of the loan amount in a penalty. It makes it undoable. But a lot of people as consumers don't know this, so we don't look. So you have to pay attention to that stuff. 660 credit score or more, you're going to want a higher credit score when you're going into a long-term mortgage. This is a little bit different than a short-term mortgage, like a hard money loan. There are local versus national portfolio lenders. I prefer national, but there are going to be some local guys where they might be just in the Northeast or just on the West Coast. They can offer specialty products. I've seen some of these local non-QM portfolio lenders offer 40-year terms instead of just the 30. So you could stretch it out to 40, get more cash flow. And that is a trend that while we haven't seen a ton of it, because I think the sentiment is because rates are projected to go back down, we are in the next year or two, we will start seeing more 40-year terms. I'm probably the only person talking about that, but trust me, it's going to happen. And then I'm gonna probably rewind this and be like, yeah, 2 years ago I was telling you guys, 75% to 80% of the ARV. So although the hard money lender will only give us 65% of the after repair value, The portfolio lender gives us 75 to 80% of the after repair value. That means there's a spread. This one will do 65, this one will do 75. There's 10% in the middle. And that's where you can refinance out money. And then the application process, once again, it depends on the lender. It just depends on the lender. So you can have no doc for the portfolio as well.